today's session. Okay. So I hope I'm visible and audible. Okay, great. So dear students, once again, greetings to all of you. I hope and I pray that all of you are doing good. The agenda of today's session is that we look at the past exam questions of the recent attempts. We will try to target 2 questions, but whatever time allows, whatever your appetite allows, we will do that, okay? So we have 2 question papers, September, December 23, March, June 23, the 2 recent available attempts at CV practice platform, okay? So let us have a look. I wonder why the PDF is not. Okay, here are these. So that we can also have these in PDF. Okay. So I hope this September, December 23 attempt is visible on your screens. Is it? Great. So we will be discussing this question from one of the recent attempts, which is September, December 2023. In the previous live session, we discussed about some exam techniques, including the exam techniques for ethical considerations, including exam technique of business risk, audit procedures. Very quickly, we discussed those techniques. We will again be discussing those techniques, but today we will be discussing those techniques with a real exam question. As far as the related concepts are concerned, as far as the related topical discussion is concerned, I've already requested you that you are requested to go through the videos on the LMS, because all these topics, all this content has already been covered. The conceptual discussion is already there. The recorded videos are there for your reference. In these live sessions, we will try to focus on maximum practice. Practice is the key to success, and we will ensure that we practice maximum questions, so that you get to see that how are we going to plan the questions, how are we going to draft our answers, and how are we going to secure maximum available marks in any of the question in AAA. Okay? So here is the question on your screen, September, December 23. I hope everyone is active. Your input is the key to success. Okay. So I would really appreciate if you have any message, if there is any problem, if you have any message, you send your messages to the host ID, because I can have the visibility of the host ID. Okay. So dear students, I would really appreciate if you can once again confirm me that everything is crystal clear and on target. Everyone? Great. So the question is on your screens. This is question number 1, typical 50-marker question, which you're likely to see. It's a very similar question you're likely to see in your examinations. We have to understand the approach, we have to develop the exam technique, okay? Requirements will usually be similar. Examiner does not change requirements. The thing which changes only is the scenario, okay? And you simply have to adapt yourself to the given scenario. If you can do that, you can ace the examinations, and that's it, okay? So here is the question in front of you. I have converted this question in PDF, okay? So that I can highlight on it, I can annotate on it. Usually you will be having in the form of exhibits. I've already opened the CBE practice platform as well. See here, you can see the CBE practice platform. See, here is the question. Here is the CBE practice platform. But I have opened it on PDF, so that we can annotate on it, we can mark on it, and we can make the best use of this, okay? So it is first, I'm starting the question, I'm starting reading the question. I will also require your input, I'll also require your involvement. It is 1st of July 20x5. You are a manager in audit department of Stanley Associates. So this will usually be the case. It's 1st of July 20x5. See, this date is important. And the year ending is 30th September 20x5. So that means you are planning the audit. The year end has not yet arrived and you are planning in advance. And this usually happens. So you are given the draft figures, you are given the budgeted, forecasted figures, and you are required to work on those figures to have your planning done before the year end, okay? You are a manager in the audit department of Stanley Associates, a firm of chartered certified accountants responsible for the audit of Hammer Group, which is not a listed company, Now, again, this is something which is very relevant to you, because we know that for a listed company, some additional requirements pop in, specifically when we talk about ethical considerations, okay? Plus, from risk assessment perspective as well, a listed entity is more inclined towards earnings management, because their results gets public, their share prices are affected, and there is a lot of potential of management biasness or management earnings, okay? So if it's a listed company, the risk automatically gets higher. Operates a number of hardware stores which supply trade, customers and the public. Okay, number of hardware stores, they operate number of hardware stores. So whatever the operation of the company is, well, it doesn't matter much. It doesn't matter much, because your approach to the question will very much be the one which you have already prepared, okay? Different industries, different businesses do have impact on your planning, but not a lot. Your firm audits all components of the group. Okay, so one thing which you also need to consider is that this is a group. And another important piece of information is your firm audits all components of the group, including a foreign subsidiary acquired during the year. This is a very important piece of information. Why? Because if you are auditing a group, you are a parent auditor. Being a parent auditor, you are required to give the opinion on the consolidated financial statements of the group. And that opinion is solely your responsibility. Whether the components are audited by other auditors, still the opinion on the consolidated financial statements is your responsibility. So, the best thing for you being the group auditor is that you yourself audit all the components, because ultimately you will be giving the opinion. And if you are the auditor of all the components, you will be having a strong hold of your opinion, because you have performed the procedures, you have done the risk assessment, and you have reliance on your procedures. But suppose if some other auditor is auditing the component and you have to rely on their work, then it gets a bit difficult. Challenges arises. How are you going to direct their work? How are you going to involve in their work? How are you going to instruct them to do as per your requirement? Specifically when the subsidiary is a foreign subsidiary. This is something problematic, because a foreign subsidiary which is not in your country, in the foreign country, there are additional risks attached to this.
Right.
Okay, so there is a bit of problem. Okay, so students, I think that there was some distortion. But I hope that now I'm clearly audible to all of you. Is this the case? Is the audio better now? Please respond me on the host ID. Is the audio better now? Okay, so everyone, can you please confirm me? Great. So, whenever there is a foreign subsidiary, additional planning considerations pop in. For example, their financial reporting framework might not be the same, their currency might not be the same, their local laws and regulations are different, and those who have gone through the conceptual videos know all these common problems which are there with the foreign subsidiary. So you do not have to get scared whenever there is information about the foreign subsidiary or different components, but rather I think you should get happy, because these issues are fairly simple, repetitive, and straightforward. Okay, so moving on. The following exhibits available on the left-hand side of the screen provide information relevant to the question, and you will usually be having these exhibits: partners' email, group structures and activities, financial information. The third exhibit usually is the financial information, business developments, and the fifth one is additional services. Okay, this information should be used to answer the question requirement within your chosen response options. And what are the requirements? Requirements will be there in the partner's email. Okay, so we'll see what the partner's email says. Okay. So, to audit manager from Paula sent us the group engagement partner Hammer group audit planning 1st of July to works 5. Hello. Hi. I met with the group finance director yesterday along with representatives from the group audit committee. So the partner had the meeting with the group finance director along with representatives of the group audit committee. So obviously whatever the discussions have been there, but those discussion points are very important from audit planning perspective. So the partner is basically discussing all those elements. We discussed the group activities during the year and its plan to expand into further international markets next year. So see, already we know that one of the foreign subsidiary has been acquired during the year. During the year, there has been an acquisition. There has been an acquisition of a foreign subsidiary, and they are still planning to acquire further companies the next year. Great. This is, I think, an important piece of information needs to be highlighted. Why? Because if they are planning to expand into further international market next year, so does their position allow them to do so? Does their cash flow allow them to do so? We have to think on it. And will they be inclined to manipulate their numbers if they intend to achieve this target? Could be. We don't know yet. But what we can do is, we can highlight this piece of information. They also provided me with some extracts from the projected consolidated statements and a selection of KPIs. I also provided you with some background information about the group to assist with the planning of the audit. Based on the analysis which I have done on the industry, it is appropriate for overall materiality to be based on revenues. So in questions, you will be given the benchmark, materiality benchmark. And obviously you have to work on that benchmark. You have to follow that benchmark to base your materiality. So now things are easier because earlier no benchmark was given to the students. So students had to use even multiple benchmarks to assess materiality. Okay. But now it's simple, it's straightforward that you are given the benchmark. So you will have to use that benchmark obviously. You will need to determine and apply an appropriate materiality threshold in your briefing notes. What simply you need to do, you need to base revenue as your materiality, consider the lower threshold, higher threshold, and give your reasoning that why are you opting the lower threshold or the higher threshold or some midway. I'll show you how you do so. Using the information below, I require you to prepare briefing notes for my use in which you evaluate business risks. You evaluate business risks faced by the group. You evaluate and prioritize the risks of materiality, risks of material misstatements. Financial statement risks. You have to evaluate. Evaluation means proper explanation, proper justification, proper application of the technique which we discussed in our previous session, that whichever risk of financial misstatement we will be considering, we have to consider materiality, we have to consider applicable accounting standard, we have to apply the requirements, we have to identify the areas which may be misstated, and the risk impact. Plus, if any numbers are given, we have also to identify relevant trends if the information is available in the question. Okay? So this entire package is called evaluation. Prioritize. We have to prioritize as well, because obviously all risks are not that problematic. All risks are not that deadly. So we have to prioritize the problematic risk first. So how do we do so? Okay, the easiest way to do is, as you go on to read the question, keep on identifying the risks, keep on making the planning pointers, keep on drafting the risks. When you are done with all the risks, prioritize the risks in the conclusion. Then which are the most significant risks. Prioritize it in the conclusion. Okay? Or you can even say in the introduction that the audit risks or the risks of material misstatements have been provided in the order of priority. That will simply communicate to the examiner that you have given the risks in the order of priority, in the order of importance. Are you getting this? Then, part C. Okay, you should refer to exhibit 2, 3, and 4 when carrying out requested risk evaluation. So obviously you do not have to go to exhibit number 5 for your risk evaluations, but 2, 3 and 4. You have to make use of all 3 exhibits. Requirement C particularly relates to exhibit number 4. But obviously the technique to attempt the question is that we have to plan these 2 things together. We have to plan A and B together. When we will be reading the questions, we will be planning these 2 requirements together. So this simply means that we are planning for 10 marks, 16 marks, 26 marks, but when we are done with this, we will not only be done with 26 marks, but we will be done with the respective professional skill marks as well. 26 into 25, how much? See. That means we will be roughly be done around 7 professional marks. Are you getting this? 7 professional marks. In question number 1, there are 10 professional marks. Are you getting this? You can see the marking distribution. 26 and 14. 40, 10 professional marks. And simply, how can you say that how much professional marks are there in these 2 requirements? Very simple. Very simple. 26 marks and you will wonder why I have multiplied it with 25. There are 20 professional marks. So there are 20% professional marks. Yes, 20% out of 100. Are you getting this? But if you make the percentage of the content-based numbers, that will be 25%. Okay? So this means that 25% of the content-based, if you multiply the content-based numbers with 25%, you will get the professional marks associated with those requirements. Okay? So although you are attempting for 26 marks, but you are automatically getting these 6.5 marks. That means you are roughly attempting for 32.5 marks. Are you getting this, dear students? Is this crystal clear to all of you? Are you with me? Everyone? Be very quick in your responses in the chat box. Host ID. I am looking at the host ID. I can see your messages in the host ID, please. Okay? Please keep acknowledging me whenever I ask you. Okay. Dear students, can you please confirm me? Am I not able to see your messages? Can you hear me? Please confirm me. Everyone? Michael, can you respond me please? Troy. Perfect. Great. So we are now going to read the question and plan the question. Okay. The key to success will be that we plan both of these requirements simultaneously together. Okay. Because we have to use all the exhibits 2, 3, 4, these 3 exhibits, and we have to plan for these 2 requirements. And if you have gone through my conceptual videos, business risks and risks of material misstatements, they go hand in hand. If we are identifying business risk, this will eventually give us the indication of the related material misstatement. Okay. For example, I give a very simple example. Suppose if there is any situation which talks about some fines, some penalties, some violations, potential outflows, legal claims, then obviously at one end it creates a business risk. How? If there is a violation, if there is any legal claim, then it simply means that if that fine or penalty is materialized, if that fine or penalty is eventually imposed, then it will result in the outflows, fine expenses, penalty expenses, and expense reduces the profit, so our profitability is deteriorated. This is the business risk. Fines and penalties affect on cash flows, so our cash position is disturbed. Fines and penalties result in bad publicity, and the bad reputation will eventually result in loss of customers. So potential future revenue is lost. So this is a business risk. But can we think of a financial statement risk from this information? Answer is yes. If there is a potential for fines or penalties, does the situation require us to book a provision in accordance with IS 37? Or is the situation warranting us to only disclose this fact? It's a possible liability. So we have to refer to the relevant standard so that we can have the impact of the figures assessed on the financial statements. And we can see whether there is any risk of material misstatement in the numbers of financial statements. So business risk and financial statement risks, they both go hand in hand. They are 2 different things, they are 2 different concepts, but as far as the assessment is concerned, the purpose of assessing the business risk is that we eventually identify the impact of the business risk on the financial statements. Although these are 2 different things, but one will eventually help to identify the other. So the planning also goes hand in hand, planning also goes together, okay? So when we will be reading the content, we will try to plan both of these together. So this is the briefing notes. I hope you can see my screens. Okay. So you cannot see the full screen. Still not. Yes. Okay. So question number 1. Answer plan. So first of all, we have to plan our answer. In planning our answer, if both of the requirements are given, business risk and risk of material misstatement, I would recommend making a table like this, in which here you can plan for business risks, and here you can plan for risk of material misstatement. Are you getting this? Okay. So we will start with the very first exhibit, which is exhibit 2. The group operates a number of large hardware stores within the domestic market. The stores supply building materials and equipment to the public and to the builders. The Hammer brand, which is internally generated and is not recognized in the consolidated statement of financial position, is key to the group's success. Internally generated brand, not recognized in the financial statements, so that's a perfectly correct treatment, so there is no problem in this information. One of the group's subsidiary, Wrenchco, is a financial services company specializing in providing saving accounts and loans to individuals. That's an important piece of information because one of the group's subsidiary is involved in separate operations. Operations separate from the group. Separate from the group's core activities, basically. Separate from the group's core activities. Okay? So first of all, okay, so what we can write here down is, we have not yet moved forward. Okay, what we can also do, we can write some important pointers here in common as well, not specifically in business risk, because we will assess later whether is it a business risk or not, but we can say one of the subsidiary is involved in financial services, which is not a core activity of the, not a core activity or speciality of the group. Just for our reference, we have written it down. Might be this could help us later down the line. Mollet Co. is a wholly owned subsidiary and operates the Hammer stores. Okay, see, first of all, let me also highlight this brand, the Hammer brand. Okay, so which subsidiary is operating this brand? Mollet Co. is a wholly owned subsidiary and operates the Hammer stores. It generates the majority of the group's income, as already told that this is the group's core brand. Mollet Co. owns, it generates the majority of the group's income. Mollet Co. owns 50 retail stores across the country. Mollet Co. has been involved in price war with another national hardware store during the year. Offering significant discounts, heavy marketing, and heavily marketing the Hammer brand in an attempt to increase the market share. Okay. I always say that whenever you will read the question, you will see that examiner is spoon feeding you the problems. If examiner is spoon feeding you the risks. So very straightforward risk which has been spoon fed to you by the examiner, this price war situation. Does it create a business risk? The answer is yes. This intense competition this high competition creates business risk. Okay, how does it create a business risk? Very simple. Price war, intense market competition, don't you think there will be pressure on margins? There is a price war, impact on profitability. Significant discounts have been offered, isn't it? If there is a pressure on margins, impact on profitability, and this is a business risk. Okay, there is call for prayers, azan in the background, so I'll be silent for a while. Okay, heavy brand marketing, so increased marketing expense. That simply means there will be increased marketing expense. profit will be impacted. Plus, there will also be burden on cash flow for other operational activities. Don't you think so? Isn't it? So pressure on margins, impacts on profitability. The other piece of information, heavy brand marketing, increased marketing expenses, profit will be impacted, burden on cash flow for other operational activities. Are you getting this? What you can also write is so with this simple information given to us in the question, we can write a lot. But the key to success is that we build the link towards the profits, revenues, loss of revenues, loss of profit, loss of revenues, burden on cash flows. If we can link our business risk with these business indicators, we can do the magics. We can secure maximum marks. Are you getting this? So are you getting that how or in which direction are we supposed to think for the business risks? Okay. As far as the financial statement risk is concerned, so directly we cannot yet link any financial statement risk at the moment. But yes, as we go down the line, we will see multiple. Lederco is an overseas subsidiary situated in Farland. Great. The group obtained a 65% shareholding. So this foreign subsidiary, I think, is that one which has been acquired during the year. Okay. The group obtained 65% shareholding in October 2024 for cash consideration of $82 million. So a lot of cash outflow has already been gone. The share purchase was financed partly using a $32 million bank loan with a variable interest rate, which was taken out in October 2004 and partly through group's existing cash reserves. The bank loan has covenants attached to it in relation to the interest cover and gearing. The purpose of the acquisition, okay, after reading this point, I'm reading this point, but after reading this point, I'll be taking a break, and that break would be comparatively a longer break because that will be a prayers break as well. Okay, so what in the meanwhile, what I would request you that you go through this question and you plan further pointers so that when we resume, you can match your planning pointers with us. Okay, so I'm simply discussing this point to make your direction clear for your working, and then we will resume after the prayers break. The group obtained 65% shareholding, so obviously the cash is already been out a lot. The share purchase was financed partly using $32 million bank loan with a variable interest rate which was taken. So variable interest rate, if the interest rate goes up, problems. Are you getting this? Business risk, profits will go down. And partly through the group's existing cash reserves, the bank loan has covenants attached to it in relation to the interest cover and gearing. What if these covenants are breached? Problems. The loan might need to be repaid, and there will be a big blow on the cash or the cash outflows, the cash reserves. The purpose of the acquisition was to expand the group's operation into a new geographical market. This is the first overseas investment made by the Hammer Group. First overseas investment, they are not much experienced in international market, and they can make operational blunders. Operations can go bad. They might not be able to control those. So poor management may lead to lack of controls and losses from business risk perspective. The 35% NCI in letter is owned by a government of Farland with regulatory requirement that at least the portion of a company's share capital is government owned. The currency in Farland is same as the country in which the group is based. So please don't identify the risk or financial statement risk based on the currency, because it's the same as which the group as of the group. Your firm was appointed as auditor of Ladder&Co, and several members of the audit team have traveled to Farland to become familiar with the company, its key management personnel and its regulatory environment. Farland does not mandate the use of IFRS. So here comes the financial statement risks. Farland does not mandate the use of IFRS, and Ladder&Co individual financials are prepared using Farland's national accounting standards. That's a risk of material misstatement. If the financials of foreign subsidiaries are not made as per IFRS, how can we consolidate? So there is a risk that these numbers are misstated as far as the IFRS are concerned. Okay, so the necessary adjustments to make these numbers in line with the IFRS might not have been done properly. There's the risk of misstatement. Are you getting this? So you will keep on reading the information, you will keep on reading the information, and you will keep on identifying the relevant pointers. So you will make the answer plan, and once we resume from the prayers break, we will continue discussing this question. Okay? Okay, so I'm simply writing it down. Okay, so there has been some problems. Okay. So dear students, the question is again on your screens, and we will continue from where we left. Unfortunately, the highlight is on. No worries. Okay. So we read this point, Mollet Co, and we were on the second point, Letter Co. So you might have planned a bit on your own, and let's see together how we can proceed. Letterco is an overseas subsidiary situated in Farland. Great. The group obtained a 65% shareholding in October 20x4. So basically this is the subsidiary which is acquired during the year, the foreign subsidiary, for which we are quite worried. Okay. The group obtained 65% shareholding in October 20x4 for cash consideration of $82 million. So 65% shareholding is important information. Cash consideration of $82 million. The share purchase was financed partly using $32 million bank loan with a variable interest rate, which was taken in October 20x4, and partly through the group's existing cash reserves. The bank loan has covenants attached to it in relation to interest covering and gearing ratio. So this is a lot of information for us to identify few very easy business risks. Variable interest rates, covenants attached to it in relation to the interest cover and gearing. So what we can simply do, first of all, investment in foreign subsidiary. What could be a business problem? What could be a business risk? Very simple. Investment in foreign subsidiary, very significant investment. Risk that it may not provided expected ROI. There is always a risk whenever there is a significant investment. And if this happens, big investment can drain, or we can say a huge investment can drain. A very simple thing, a straightforward thing. Another point. Okay, I'm simply writing down the pointers, and these pointers will be strengthened as we move on. Bank loan. A significant bank loan has taken to finance this acquisition. Variable interest rate of significant bank loan. Obviously, if interest rate rises, impact on profitability, plus covenants attached to bank loan, if they are breached, loan becomes repayable, resulting in significant cash flow issues. By reading this information, we can at least make these our planning pointers. I hope my screen is visible. Yes, it is. Okay. So 32 million bank loan should also be highlighted. The purpose of acquisition was to expand the group's operations into a new geographical market. This is the first overseas investment made by Hammer Group. Okay. New geographical market. So basically, new geographical market, management has no experience in operating on this location. So these are all the pointers and information which will be strengthening our business risk. This is the purpose of the planning phase. Because obviously, as we move on and as we keep on building our answer, or as we move on building our answer plan by utilizing all the available information, our answer gets strengthened and we can easily avail all the marks which the examiner has kept for us. Okay, so this is how the beauty of the answer will be enhanced. So whatever pointer you are making, and if you feel that any information is supporting your point, is supporting your argument, keep on building that. Okay, so as we moved on and as we saw this information that it's a new geographical market, although we already knew this, so since the examiner has also emphasized this point, so we inserted into our pointer. This is the first overseas investment made by the Hammer Group in operating outside the home country market. This is the first time. So the foreign investment is not an issue. The issue is that entity has not operated in any international market before this experience. The purpose of the acquisition was to expand, this is the first overseas investment and we made use of this information. Ledderco owns 50 hardware stores in Farland. Okay. The 35% non-controlling interest in Ledderco is owned by a government. Now, this is again a very important piece of information. Due to a regulatory requirement. Now see, okay, let's complete this point. At least that portion of the company's share capital is due to regulatory requirement that at least that portion of company's share capital is government owned. Okay. Now, what is the impact of this information? Okay, impact number one. Government involvement in operations, political influence which may impact business operational management and could result in inefficiencies and failure to execute the desired business plans. And which may impact profitability again. And we can also say that lack of experience management skills, lack of knowledge of local laws and regulations may result in failure of international business, resulting in potential losses. So see how much can we write, how much there is room to expand or strengthen our point if we are capable of utilizing the information given to us. Are you getting this? So see, the purpose is to show you that how important the answer plan is. Okay, can we say that any financial statement risk arises here with the help of this information, government involvement? The answer is yes. %35 ownership of the government in Farland Company, I think. Now is it visible? In Farland Company. IFRS 10 says the entity becomes our subsidiary. I'm not writing all the narration because obviously since I am explaining to you, so you are listening to it, you are carefully hearing to it, and obviously you can draft the pointer. I will also show you, we will also discuss the suggested solution, but the point is if we can make answer plan strong and sufficient enough to explain our pointers, we are good to go. And if you can focus on what I'm explaining, this is what you are supposed to write in your answers. As per the requirements of IFRS 10, the entity or the subsidiary is consolidated. The acquired entity qualifies for subsidiary if the investor exercises control over investee. Control or power over investee. Rights to variable returns. Exercise decisions. If government holding by virtue of rights is sufficient enough to hold back the group in exercising control or taking decisions, there may be lack of control or power over investee. Entity may not even qualify for being classified as subsidiary. There is a risk Very simple. 35% government ownership. What are the rights attached to those 35% ownership? That's a big question mark. So here, by reading this information, all these points should come up in our mind. Okay? If government holding by virtue of rights is sufficient enough to hold back the group in exercising their decisions, there may be lack of control or power over investing. So foreign entity may not even qualify for being classified as subsidiary. So risk of misclassification as subsidiary and results being wrongly consolidated. Are you getting this? It's a financial statement risk. Which area, which standard, which misstatement, and these are the planning pointers which we can make. Okay? Then the currency in Farland is same as the country in which the group is based. So there is no foreign currency risk because the currency is same as of the group. Your firm was appointed as auditor of Ledderco in 2004, and several members of the audit team have traveled to Farland to become familiar with the company, its key management personnel, and its regulatory environment. Farland does not, regulatory environment, we have already made use of this information that they might not be aware of the local laws and legislations. We've already incorporated those in our planning pointers. This in our planning pointers. Farland does not mandate the use of IFRS, and see, this is the information we're looking for. Does not mandate the use of IFRS, and letters individual financial statements are prepared using Farland's local accounting standards. Now see, this is something for which so this is a separate pointer than this. Use of so what we can simply say, don't forget to assess materiality, it's material. Materiality, when we will be looking at the numbers, when we will go to the numbers, we don't need to jump over the numbers yet. But see, we simply know that the acquisition is quite material. Consideration. See, it's $2 million. It's material. Will be material, okay? So you have to assess materiality, use of local accounting standards. This is material, obviously this point is material by nature, because even if the amounts are not material, even if the amount is not material, this point is material by nature, because the standard necessitates that the subsidiary should be applying the group's accounting policies. Okay? What is the risk? Groups accounting policies for IFRS 3. Might not have been applied. Plus necessary accounting adjustments to bring the financial statements in line with IFRS have not been made. This is a risk. Are you getting this? Very simple. Respective standard number, the risk, and its application. Misstatement could be under or overstated. The numbers could be under or overstated. But this is a financial statement risk, obviously. Okay, moving on. Renchco is the financial services company of the group operating a Hammer Bank. Its customers are mostly trade customers who obtain credit and loans to finance long-term building projects. Okay. Obtain credit and loans to finance long-term building projects. In the last year, the financial services regulator has been investigating many banks for charging excessive fee. Okay, so here we will stop. So the group is involved in providing some different services than its core operations. So obviously, we can simply say that if the criteria okay, since we do not know the numbers yet, but we can talk about materiality and we can talk about the risk that operating segments have not been disclosed and we will be describing the requirements of IFRS 8. Okay? The profitability threshold, the asset threshold, we have to explain it. And we can explain it in our answers, no need to explain it here in the planning pointer. Okay? So this could be another risk. Remember one thing, you will be awarded credits for all the relevant pointers, no matter that risk is there in the suggested solution or not. The examiner specifically says that if you make any relevant point which is even not in the suggested solution, you will be given credit for that. In the last year, the financial services regulator has been investigating many banks for charging excessive fees to customers. Okay, before moving on to the further information, can we say this could be a business risk? In new industry. Financial services is not a core area of expertise of group. They will be lacking. Okay, number one thing is it's a highly regulated area. And they may lack necessary skills and experience to manage these operations, which may result in failure of business, resulting in significant losses. So it becomes a business risk. Simple. See how simple it is to score marks, how simple it is to pick information and make a risk out of it. And see a point to ponder and a point to remember when we are drafting business risk, when we are looking at business risk, we are not talking about the misstatement in the financial statements. We are not concerned about the misstatement in the financial statements. We are simply concerned about the operations of the business, business performance indicators, impacts on profitability, impact on future operations, future sales, burden on cash flow, which may result in problems for the business operations to be continued, because obviously cash flow is the running blood of the business. So here we are not talking about any hanky-panky or misstatement in the numbers of financial statements, any violation of the standards. We are not talking about any violation of the standards in business risks. But yes, when it comes to financial statement risks, we are talking about standards. We are talking about misstatement in financial statements, how the problem could affect the numbers in financial statements. This is the prime distinguishing feature between these two risks. So what students usually do, they confuse between these two things, okay, which results in losing very easy marks. So please be very careful about that. In the last year, the Financial Service Regulator has been investigating many banks for charging excessive fees to customers in relation to loans, meaning that customers can claim back excessive fee they have been charged. Ranchco has received legal claims from more than 25,000 customers in respect of this. Okay, charging excessive fee, legal claims. Okay. So very simple and a straightforward thing. Can legal claims result in business risk? Yes. And this is the easiest point of business risk, which can easily fetch you full available marks, because it has been tested multiple times in the past examinations, legal claims. And the bottom line is very simple for all such requirements which have appeared in past examinations. Legal claims. And what are those? Fines and penalties for violation, impact on profits, settlement of legal claims in case of adverse decision, burden on cash flow, plus expense, bad reputation, loss of customers, and even in some cases this may result in going concern implications if regulator takes strict action. So I've written the general pointers which you will see. I've written general pointers which you will usually see in all the questions where you find any information about any non-compliance, legal claims, fines and penalties, provision related pointers. So these will be the guiding lines on which you have to draft your answers. Fines and penalties for violation. Whatever the violation has been discussed in the question, that violation may attract fines or penalties which may have an impact on profits, which will have impact on profits. That's business risk. Why is it a business risk? Explanation from another perspective. Whatever the litigation is, whatever the legal claim is, if the decision comes against us, our client, outflow of settlement of claims, outflow for settlement of claims, cash outflow, burden on cash flow, operations will suffer. Expenses, extra payments may need to be made. Expenses will increase. Bad reputation. If the decision comes against the company, it will result in bad reputation, loss of reputation. The customers may be lost, loss of customers. Going concern implication. Regulator takes a strict action. There could be going concern implications. Are you getting this? The business may be closed. Some students usually question that going concern. Whenever they see this terminology, going concern, they simply say, sir, this is a financial statement terminology. So doesn't this terminology link to the financial statement risk? The answer is that going concern problem is a business risk. It's not a financial statement risk. Its related implication will result in financial statement risk. Because going concern means operations of a business, operability of a business. If the going concern of a business is questioned, the operations are questioned. Operations are questioned. And any threats or problems to business operations, business performance, this results in business risk. Are you getting this? But yes, this situation will give you some hint that there could be financial statement risk. Why? Because if the entity fails to disclose this going concern problem appropriately, then IAS 1 says that this is under disclosure. IAS 1 says that they need to be disclosed. And if they are not disclosed properly, it's a violation of IAS 1 and it becomes a financial statement risk. Are you hearing this, everyone? Okay. So what could be the financial statement risk? Can there be financial statement risk? Answer is yes. This situation gives rise to both the business risk plus the financial statement risk. How? Because we know that IAS 37 is a standard which guides us about the situations where the provisions may be required. Risk that okay, what is the requirement of IAS 37? Can anyone tell me what is the requirement of IAS 37? Present obligation as a result of provision should be required when there is a present obligation as a result of past event. Resulting in probable outflow of economic resources and amount can be ascertained reliably. I hope this is the requirement for recognition of provision. If the criteria is met, the provision is required to be made. If not, disclosure only if possible outflow or amount cannot be certain reliably. Plus, the details also need to be disclosed. Not only the amount or the monetary provision which needs to be recorded, but a note if this is a significant amount. A note is also required which explains things in detail. We'll also talk about materiality if the numbers are given. and numbers are given obviously. So let's not forget about the materiality, which we will be making on the basis of revenues. Okay, 0.5 to 1% of the revenue. So we will also calculate 0.5% of the revenue and 1% of the revenue. It's safe to base the materiality on the lower end, but we will discuss when we will be actually looking at the drafting end of the answer. Then we will see that how the numbers of materiality are calculated. So don't worry about that. It's very simple and easy and straightforward. And we will also see that how is it going to be drafted, because what I want is that you actually attempt this question on your own, and then we'll look on to see the drafting, and we might also check your answers. Okay. So legal claims. Provision of 22 million, and obviously since the revenue is given, so we will make our initial materiality calculations based on this revenue. 0.5% of 450. We will be calculating this as well. It's it's $2.25 million. Okay, so this provision is highly material. Are you getting this? Highly material. If I remember correctly, the materiality to be based on revenues. Okay, perfectly fine. Okay. So the extracts from the projected consolidated financial statements are given, including notes for the year ending 30th September 2005. Revenue is given, perfectly fine. So we will be required to simply calculate few increases and decreases, easy increases and decreases. Operating profit before exceptional items, 97.78, and then operating profit after exceptional items, it has decreased significantly. And why it has decreased? Note 1 will guide us about this. Exceptional items are those determined by management to be non-recurring. In 2005, exceptional items relate solely to store enhancement costs. More detail is provided in exhibit number 4. The exceptional items in the prior year were audited in 2004 and no exceptions were noted. The executive directors each earn an annual bonus which is based on annual increases in operating profit before exceptional items. So very interesting point, very interesting point. Store enhancement costs. And store enhancement costs, the details relating to store enhancement costs coming in exhibit number 4. It's very interesting. So from here, what I would really appreciate that although you might have read this question, you already planned it, but these points are very interesting and these points could be easily drafted by students. Okay, so what I really wish is that you actually attempt this question, these two requirements, business risk and risk of material misstatement. You think on your own, you utilize your own brains, you write down the answers. Okay, and in tomorrow's session we continue this question with your drafted solution. Okay, so I am simply discussing this in brief. I am not making the pointers now. I want you to think over it and draft the pointers. Okay, so see, there are a few non-recurring elements, and in financial statements what they've done, they've shown 2 lines, operating profit before exceptional items and operating profit after exceptional items. And what are the exceptional items? These are non-recurring items determined by the management. And exceptional items relate solely to store enhancements. Executive directors earn annual bonus on operating profit before exceptional items. So can there be a chance that executive directors might play with this opportunity and might shift the expenses to the exceptional side so that profit before exceptional items remains high? Because they have the incentive to manipulate profits, because they have incentive to earn bonuses if they keep the profits before exceptional items high. They might have done that. They might have played with the numbers. Earnings management, management biasness, manipulation, risk of manipulation in profits. So this is another financial statement risk, which is a very important one. Okay, so you may make use of all this information. So, and this is the information relating to store enhancement costs. That 25 outlets needs to be renovated, needs to be made part of the enhancement program, and a significant cost will be incurred. So significant cost will be incurred. So can this be a business risk? Yes. Significant cost will be incurred. So will this be a revenue expenditure or a capital expenditure? Well, it needs to be looked at from IAS 16 perspective. Is it a revenue expenditure? Is it a capital expenditure? If it's a capital expenditure, it needs to be capitalized. But if it is of a revenue nature, for example, renovations, for example, routine maintenance, then those should go to profit and loss. And does it necessarily be an exceptional item? Answer is no, because routine maintenance or renovations does not necessarily be exceptional items. So if the management has classified those to be exceptional items, their intention may be malified. Their intention may be to manipulate profits. Are you getting this? So you have to think on that perspective. Plus, such a big enhancement cost per store. Big drain on cash resources. Business risk. What if they do not generate sufficient returns? Business risk. These stores will be enhanced. They will need to be closed for certain duration. What if the customers are lost? Business risk. Are you getting this? So you have to think from that perspective. Inventories include materials such as painting, decoration, material, timber used by professional builders to improve their homes. Inventories are measured in accordance with IS2. The group operates a stock take once a year. Okay. Note number 2. So inventories have increased. Okay. And they have obviously a lot of inventory. So can we think of a risk relating to inventory? The items may be obsolete. They are also running some promotion. 1-on-1 free item. You have already seen that they are running the promotion to be competitive, to be competitive with their, to keep prices competitive with their competitors. Okay, so one product free on another product. So can this mean that the product or NRV may go even below the cost? Risk. IS2. Financial statement risk. So you have to write it down. You have to note it down and you have to explain it properly. Are you getting this? Then the indicators, the financial indicators are given. You have to make use of these indicators. You have to make use of this information in your answers. Are you getting this? So, all this information, if utilized properly, can make a perfect answer. I've already guided you how you have to plan. I've already given you a roadmap, how you need to proceed in your answers. So you have to complete this planning phase, and then you have to completely draft few financial statement risks or business risks. And in tomorrow's session, which may be a prolonged one, we will be completing the discussion of this question, and we will try to attempt another question completely, hopefully. Okay, so I'm keeping this session till here, and we will resume this question tomorrow. But what I want is that you attempt this on your own and show it to me. Okay, so thank you so very much, dear students. Thanks for your involvement. Thanks for your participation. May Almighty bless you all. Take care a lot. See you tomorrow. Bye-bye.